What is SIP? Systematic Investment Plan. Systematic Investment Plan, SIP, is a disciplined investment strategy in which an investor regularly invests a fixed amount of money at regular intervals, typically monthly or quarterly, into a mutual fund scheme. SIP allows investors to buy units of a mutual fund scheme on a specific date of each month regardless of the market conditions. This approach is often used for long-term wealth creation and can help investors benefit from rupee-cost averaging. History of SIP. The concept of SIP originated in the mutual fund industry as a means to encourage retail investors to invest in a disciplined manner. Here's a brief timeline of SIP's history. 1987, the first mutual fund in India, Unit Trust of India (UTI), introduced the concept of SIPs under its schemes. 1993, SEBI, Securities and Exchange Board of India, was established, bringing regulations and guidelines to the mutual fund industry, including SIPs. Early 2000s, mutual fund houses started aggressively promoting this as a way for retail investors to participate in equity markets with discipline and without the need for large lump sum investments. 2003-2007, the Indian economy experienced robust growth during this period, leading to increased interest in SIPs as a tool for wealth creation. 2008 global financial crisis. SIPs gained further popularity during this period as investors realized the benefits of rupee-cost averaging and long-term investing. 2010s, with advancements in technology and digital platforms, investing in SIPs became more accessible and convenient for retail investors, leading to a surge in SIP inflows into mutual funds. Present day, SIPs have become a mainstream investment option in India, with millions of investors using this method to invest in mutual funds regularly. What are the benefits of systematic investment plan? 1. Disciplined investing encourages regular investments, fostering a disciplined approach to wealth creation. 2. Rupee-cost averaging helps mitigate the impact of market volatility by averaging the purchase cost of units over time. 3. Long-term wealth creation, suitable for long-term financial goals such as retirement planning, children's education, etc. 4. Flexibility. Investors can start with small amounts and increase their SIP amounts over time as their income grows. 5. Automatic investing. Once set up, SIPs automate the investment process, reducing the need for constant monitoring and decision-making. 6. Diversification. SIPs allow investors to diversify their investments across various mutual fund schemes and asset classes. Let's go beyond the surface level and dive into the SIP advantages that goes beyond the surface level. 1. Rupee-cost averaging, a mathematical advantage. SIPs don't require timing the market. By constantly buying units at various price points, highs and lows, SIPs average out the cost per unit over time. Let's see with an example. Imagine you invest $1,000 monthly into an SIP. In a bull market, you buy fewer units when the price is high. In a bear market, you buy more units when the price is low. This automatic averaging reduces the impact of market volatility and potentially leads to a lower average cost per unit in the long run. 2. Compounding. The power of small, regular investments. Albert Einstein called compounding the eighth wonder of the world. SIPs leverage the power of compounding. Each installment you invest earns returns, and those returns themselves earn returns over time, interest on interest. Even small, regular investments can grow significantly over extended periods due to compounding. 3. Psychological benefits. Overcoming fear and greed. SIPs remove emotions from investing. By automating investments, you avoid the temptation to invest heavily during market highs, fear of missing out, or panic sell during market lows. SIPs instill discipline and a long-term perspective, crucial for successful investing. 4. Flexibility. Tailoring SIPs to your needs. SIPs are incredibly flexible. You can A. Start with small amounts, as low as $500 in some cases, and gradually increase them as your income grows. B. Choose the investment frequency, monthly, quarterly, etc., that suits your budget. C. Invest in various mutual funds to diversify your portfolio and align with your risk tolerance. SIPs are a gateway for anyone to participate in the stock market, regardless of their initial capital. Additional considerations in terms of systematic investment plan. 1. Time horizon. SIPs are best suited for long-term goals, 5+ years. The longer the investment period, the greater the benefit of compounding. 2. Goal planning. Align your SIP investments with your financial goals. Choose SIPs and mutual funds that match your risk appetite and goal timelines. 3. Review and rebalance. Regularly review your SIP portfolio and rebalance it if needed to maintain your desired asset allocation. SIP options available in the world based on sectorial and industrial investment. A. Technology sector SIPs. These SIPs invest in companies involved in technology development, such as software, hardware, and the internet. Technology is a growing sector with the potential for high returns, but it can also be volatile. B. Healthcare sector SIPs. These SIPs invest in companies involved in the healthcare industry, such as pharmaceuticals, biotechnology, and medical devices. The healthcare sector is a defensive sector that tends to be less volatile than the overall market. C. Consumer staples sector SIPs. These SIPs invest in companies that produce essential goods that people need regardless of economic conditions, such as food, beverages, and household products. Consumer staples SIPs are a good option for investors seeking stability and income. D. Financial sector SIPs. These SIPs invest in companies that provide financial services, such as banks, insurance companies, and investment firms. The financial sector can be volatile, but it can also offer high returns. E. Energy sector SIPs. These SIPs invest in companies involved in the energy sector, such as oil and gas companies, utilities, and renewable energy companies. The energy sector can be volatile, but it can also offer high returns. These are just a few examples, and many other sector-specific SIPs are available depending on the investment provider. It is important to do your research before choosing a SIP to ensure that it aligns with your investment goals and risk tolerance. Additional things to consider when choosing a sector-specific SIP. 1. The overall health of the sector. Consider the current and future outlook for the sector before investing. 2. Your investment goals. Are you looking for growth, income, or a combination of both? 3. Your risk tolerance. Sector-specific SIPs can be more volatile than diversified SIPs. By carefully considering these factors, you can choose a sector-specific SIP that is right for you. Comparison between different investment trading strategies. Choosing between different investment trading strategies depends on your financial goals, risk tolerance, time horizon, and investment knowledge. There's no one-size-fits-all answer, as each strategy has its pros and cons, and what's suitable for one person may not be suitable for another. Here are some considerations. A. Risk tolerance. If you have a high risk tolerance and are comfortable with active monitoring and decision-making, you might consider intraday or swing trading. However, if you prefer lower risk and a more passive approach, long-term investment or SIPs may be better. Time horizon. Your investment goals and time horizon play a crucial role. If you have short-term goals or need liquidity, intraday or swing trading might be appropriate. For long-term goals like retirement or wealth accumulation, long-term investment or SIPs are more suitable. C. Knowledge and experience. Trading strategies like intraday and swing trading require a good understanding of technical analysis, market trends, and risk management. Long-term investment and SIPs are more straightforward and suitable for beginners or investors with limited market knowledge. D. Diversification. Consider diversifying your investments across different asset classes and strategies to manage risk. For example, you could have a mix of long-term investments, SIPs, and a smaller portion allocated to trading if you have the expertise and risk tolerance. Ultimately, the better strategy depends on your individual financial situation, goals, risk tolerance, and investment knowledge. It's essential to assess these factors and consult with a financial advisor if needed to make informed investment decisions. Disclaimer: the content presented in this video is generated using artificial intelligence and incorporates current market data. The information provided is for educational and informational purposes only. Etherium Marketing AI, name of YouTube channel, does not provide or endorse any financial advice. Viewers are encouraged to conduct their research, consult with financial advisors, and make independent decisions based on their financial goals, risk tolerance, and investment knowledge. Financial disclaimer for Indian market. Investing in financial markets carries risks, and past performance is not indicative of future results. The value of investments may fluctuate, and investors may incur losses. It is essential to understand the risks associated with investing and seek professional advice before making investment decisions. Disclosure: the creators of this video may have positions in the financial products or securities discussed. Viewers are encouraged to conduct their research and due diligence before investing.